So first, let me give it an illustration first before we get to the chart to show the main thing on the main chart. So this very candle happens to present 1 day candle. This candle happens to present 1 day candle. Let me say this was yesterday candle. So as this market, as this candle is, here was the highest high this market has gone to yesterday, and here was the lowest low he has gone to yesterday. So we mark the low and we also mark the high. We also mark the high. So for you to trade this pattern, you can risk just 2% of your account. You can only risk 2%, which is to say you are risking 2, 10, 20. You are risking $2 to target 2 times 10 is $20, which is to say you are risking $2. You can make $20, and if you lose $2. Or if you are risking $5, which happens to be your 2%, then you know that if that happens to go 1:10 will give you $50, but if you go 1:15, you know that you are going to make approximate at least that kind $70. That is if your 2% of your account is would be up to $5. But this is not really the main fact. It depends on your risk appetite. If you have to risk 5%, that is for you. But as for me to be at the safer side so that I can still see capital to keep doing this for the next 10 years to come, I'll choose to trade with just 2% of my account. So here was the highest high and here was the lowest low. So as this market opened today, we are expecting something like this to happen. As the market opened, we are expecting something like this to happen. So this is the first thing we are going to be looking at, something like this. So let me explain this very diagram right here. So we are expecting something like this to happen, which is to say, as this market open, it comes into, because this high now happens to be our LQ, which is where liquidity lies. This doesn't happen all the time, but at least you can see this twice in a month. Yeah, twice in a month or 3 times in a month, or it depends on the market and it depends on your entry criteria, because you can be trying to enter a trade on a second and the market will stop at 3 minutes candle and reverse against you. So this is not predictable. This is not predictable. It's just what the market gives you is what you take. So what happened here is the LQ, and the market come back and grab the LQ here, which happens to be our draw of liquidity, which is happen to be our liquidity. So once the market comes to the high and clear all the liquidity, which is to say it went above this high. If the market happens to go above this high, if this day was yesterday and today the market happens to go above this high, we are going to wait for a shift in market structure, which happens right here. A shift in market structure. This can happen on our daily candle. On our daily chart, we have to move down to a smaller time frame for us to look for a shift in market structure. Upon the shift of this market structure, then we wait for our order block. We wait for our order block around this level. Our order block will be around this level. So once the market comes to a retest, when the market comes in, it retested this zone right here. That is where we are going to look for our order block or a confirmation candle around this spot for us to take the market down to the downside. So we target the downside, which is right here. This will be our draw of liquidity again. This will be our liquidity again, which happens to be the previous day low, or it will be Asia low, which is also where liquidity lies. So we are going to target here. The market has to come below this. Here will be our TP. So this is it. So let us get to the main chart right now. So to take that small account you have to something that is tangible, you have to stay on the bigger time frame. Whatever you are doing, you should take the bigger time frame into consideration. How will you do this? One, now I'm on G40. This pair is very, very volatile, and trader with a smaller capital can also do the same thing. It can, smaller trader with $5 or $10 can literally trade this pair. So it's volatile at same time, still gives you the leverage as a small trader. So I'm on a daily chart. Right now on this daily chart, what you should be focusing on is the previous day candle, daily highs and lows is what we are going to be focusing on. How are we going to do this? We are not going with the train. When it comes to this, we are not going with the train. And I'm also going to show you how you can go with the train, but for the sake of this strategy, you are not going with the train. How you do this is for you. Okay, let's start here. Let's start here because the same thing happens here. This is for you to know if it works or it doesn't. So you can see this very day, this candle closed very bullish, closed very bullish. That was the low, and here was the high. It was the wick. It was the wick right there, this candle. So what happened is, as the day, another day opened on this candle, another day opened on this very candle right here. On this very candle here, another day opens, and what you should be looking at is for you to monitor this, the high of the previous day. Is for you to monitor the high of the previous day. How will you do this? If that day open, watch out for London section. We are trading London here. Watch out for your London section. If this trade happens to break structure during the London section to the downside, I will show you, because at this point this was happened January, so we can't have all the data right here. So I will show you when we go to something like February, which is this very month. So for the sake of this scenario, once this high is being grabbed, it's for you to look for something like this. It's for you to look for something like this. Once the high grab, you look for something like this. Something like this. This is a daily chart, so it's really not easy to do this here. So this is what you would do. You look for something like this, and this has to be done on a smaller time frame, not in a daily, on a daily chart. So you look for a break in market structure once this high is being grabbed. So that's what you'll be looking for, and you take the trade. Let me say you target this previous, the previous day low, or you can go 1 to 10 or 1 to 15, depends on you. That same thing happens right here. It happens right here. Here was a high of the previous day, and here was a very low. I'm just preparing you toward what we are going. I'm going to show you. That's why I'm preparing your mind. So what happened is, this market grabs this high. Once it grabs this high, you look for a break of structure. You should go to your 5 minutes. So once this high is being broken, you look for a break of structure. So once structure breaks and retains it, you take your trade to the downside, and you can see the market keep going. So this day happens, we've seen a break of structure right here, but I don't know if something happened. There is something that will make this not to work, because for this very one to work, it has to come back and grab the low of this candle. So this was a fail. This very one was a fail. But if you are targeting 1 to 10, this can be a bigger RR for you though. So that was that. That is straight trade. Then the same thing happened today. That was why I said I'm preparing your mind towards what I'm going to show it to you guys. So that same thing happens today. You can see here was a high of the candle, this very place. I think, okay, previous day candle, it was this one that has wick. So that was it. And here was the lowest, like I said. And here was the candle. Here was the previous candle high. Here, that was where it stopped. The previous candle high. I'm sorry for the noise, guys. It just, it's not easy right here. So that is the previous day candle, previous day candle high. So let us go to smaller time frame like M5 to show you what you will do, because with this strategy you are going to be making use of two indicators. So this happens today. This is how you can, instead of you waiting for the train, like we said, let's trade with the train. Instead of you waiting for the train, you can also maximize your profit using this setup. So if you had an idea about this setup, you would have been able to cut this trade today. So let's go. You can see I'm trying to identify the previous day wicks. Previous day. Okay. Okay, the previous day, where it stops. Where it stopped, where it stopped. Where did I mark? Okay, look at where I marked right here. So this very line, this place right here was where the previous day high. Yes, that was where the previous day high stops. So let's make use of our indicator, which I call kill zone. We have key zone right here, and we have another indicator right here. The key zone doesn't shows very well, but the key zone, I don't know why it doesn't shows. It doesn't shows very well. That's why I'm using this one by Lux Algo. I have a video that explains how you can set up this your Lux Algo session. So once you plug in your Lux Algo, this is around 8. If you are using Nigerian time, this will be around 8. You stand up, you set up your Lux Algo, or you should be on your chat before 8 o'clock. Let me say 5 minutes to 8. You should be on your chat. So once you be on your chart, this is on your M5 now. Once you notice that this market has grabbed the previous day high, which is this line, which is this very line, when you notice it has broken out of this previous day high right here, this line is previous day high. So you wait for the market to break out of this line. Okay, the kill zone has appeared, which is this green box right here. If you can see it very well, here is the kill zone. So once it has broken out of this line, what you should be looking at is a break of structure to the opposite direction, which happens here, which happens right here. You can see as the market break to the upside, it creates a structure here, it took it out to the upside, and it comes back and break this structure to the downside using this. You can see here is where it's broken. And if you scale out, you will see that this very candle right here, if you scale out, you see that this very candle right here, this one was the one responsible for that break, because you mark out the last bullish candle, the last bullish candle that lead to that. So you wait for the market to come into this zone for you to take your trade right there. Yeah, right there. So as the market comes into that candle, that is where you will take your trade. And what will be your target? You can target 1 to 15. Yes, you can target 1 to 10. That is to say, if you are to risk $3 right here, you'll be making $30. But if you are to risk $3, go 1 to 15, you are to make approximate, I think that will be $45. So that will give you $45 right here. That will give you $45. So your stop loss has to come a bit above that zone. Your stop has to be a bit above that zone, and you can go 1 to 10 or 1 to 15. It depends on you. So that is 1 to 15, and here will be one. Here will be around 1 to 10. It's right there. While below, the target below will give you your 1 to 15. With this, you are done for the week. If you are having a bigger capital to trade, you have done with the week for the week. But you know, at times it doesn't happen this way. You may place a trade, they will come and take you out, then you call it a loss. But there is another thing I wanted to show it to you guys, because the trend right here is the bigger market, the biggest as in the market is bullish. Yes, the daily chart is bullish. So once the daily chart is bullish, you can go to your M15. I think this video is it's already taking much our time. We will check that next time, guys. So subscribe to this channel, turn on notification bell for more videos to come. Peace.